Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialist, Oriane Palmentier.
Hello.
Today we're going to talk about the repricing and gilt yields that we've seen this week, the ECB ahead of Sintra next week, the supply outlook for the second half of the year in the euro area, and French political risk.
Right, maybe Imogen, let's start with the UK this week. Markets have significantly repriced in recent sessions, now have less than one full hike being priced by year-end. 10-year gilts are about 45 basis points off recent highs and now obviously some way below your 5.25 target now. How do you see this evolving in the coming weeks?
Yeah, I mean, I guess the rally in rates, it hasn't been a kind of UK specific phenomenon. And there's certainly been some global narratives at play this week. We've had the movement in tech stocks and the spillover that has had into rates markets. We've had oil prices take another leg lower and are now at kind of pre-war levels on the news of, well, first of all, a deal and ongoing negotiations related to that, but perhaps more importantly as well this week, the news of ships passing through the strait. And then we've also had some domestic factors. We've had in turn the impact that those lower oil prices has on the BOE's reaction function. And of course, we've had some movement on the domestic political front. I guess to cover each one of those off in turn, starting with the movement in tech stocks. I mean, I'm certainly no expert, and in this podcast, we've generally tended to focus on rates rather than equities, given our expertise. But I think the strong Micron earnings overnight potentially sets the stage for a little bit more optimism over the next couple of weeks as we head into reporting season for the main culprits. On the oil front, we have prices back at pre-war lows, as I said, which I would argue reflects an optimism that is perhaps not necessarily grounded in reality. We have some ships passing through the strait, but of course still quite limited, and a return to pre-war levels on a very near-term basis feels quite unlikely. And you also have shipping costs and insurance costs, which remain very elevated even as passage through the strait resumes. So it would feel prudent to me that the market should be pricing in at least some premium of hiccups and breakdown in negotiations. So, even if they're just bumps in the road and only temporary, it feels like the market is in a very optimistic place when it comes to the outlook for energy prices, which I'm not sure necessarily reflects the actuality of the situation. So we've had front-end rates that have broadly tracked oil prices lower. I mean, we've talked a lot, I think, in this podcast over the past couple of months, really, about how there's been this disconnect between market pricing for the policy path for the Bank of England versus consensus expectations. And we've had for a long time that market pricing has reflected a much more hawkish outcome than what we perceived consensus to be from our client conversations. And then that was kind of verified by what we see in the market participant survey from the Bank of England, for example, where the median response has been for rates on hold and ultimately lower through 2027 rather than the rate hikes that the market has been pricing. So it feels right, I suppose, that on that basis that market pricing adjusts a little bit lower. It feels now that it's kind of more closely reflecting what has been a widely held consensus for some time. But we now only have one hike priced in over the next 12 months, which to me feels like we might be verging on getting a bit too dovish. I think the risks are still towards higher rates rather than lower rates. I'm not sure that cuts should be entering the distribution yet. And going back to what I was saying earlier on oil prices, it feels like we're sort of at peak optimism there, and there should be some upside risks considered. And particularly when you compare that market pricing to our base case, which is still for 2 hikes over the next kind of 12 months. We have them in Q4 and Q1 2027. Acknowledging that the risks to that view are to the downside, and that puts us very much at the hawkish end of expectations. But there is still inflationary pressure in the system, which cannot be undone by the signing of a deal or passage of ships through the strait. And we think that inflationary pressures will only become more evident in the coming months. So whilst there are downside risks to our forecast of 2 hikes, oil prices would really have to sustain at current levels for a long time for those downside risks to materialize. And as it stands, we are comfortable, still holding that view for 2 hikes at year end.
And what about the domestic fiscal risks? I think you'd be forgiven for looking at the gilt market this week and not realizing that the PM has resigned, given how little volatility it created in markets.
Yeah, you're right. I think that probably was a reflection of the fact that it was a very well expected outcome now after a couple of weeks of speculation, and then obviously the by-election results on Friday with Andy Burnham winning. We've long argued that the market is quite complacent around upside risks to borrowing in the UK. I think there's 2 things that have appeared to comfort the market or add to that complacency this week following the resignation of Keir Starmer and Andy Burnham being favourite to replace him. The first is that who Andy Burnham reportedly has in his camp in terms of the advisors that he's bringing on board. So Andy Haldane, the ex-chief economist at the Bank of England, Jim O'Neill, Richard Hughes from the OBR. And then the second is his reported preference for Chancellor. So there's been a couple of articles over the last sort of 24 hours that suggest he has a preference for Wes Streeting over Ed Miliband, which on the surface appeals like a more market-friendly outcome, I guess, just in terms of probably their spending and borrowing priorities. Just a couple of points I would make related to that, though. The first is that, and this is a point we've made on this podcast quite a few times over the last couple of months, is that sort of regardless of who is in charge, whether we're talking about the Prime Minister here or even who is Chancellor, the tightening that the OBR is projecting in terms of fiscal policy over the next couple of years, we think is quite unlikely to be delivered. The OBR has optimistic growth projections on the basis of very over-optimistic productivity gains and some backloaded spending cuts, which we think are unlikely to be delivered in the years ahead of a general election, particularly for a Labour Party that's polling the way that it is in the polls. And so that fiscal tightening feels unlikely to materialize regardless of who is Prime Minister or who is Chancellor. It would be very difficult for anybody to deliver, I think. So, for the market to get hung up on who could be Chancellor under a new PM feels a little bit like it's missing the wood for the trees in a way. And then the second point is that, one of the reasons why the market hasn't been as worried about upside risks to borrowing under the potential for a Burnham government is because of some comments made a couple of weeks ago around him having no plans to change the fiscal rules. And that's been reinforced, I think, in terms of market perception by him bringing on the likes of Andy Haldane and Jim O'Neill, as I was talking about earlier. The market considers them to be, sensible economists who understand the market dynamics. And therefore, the market is assuming, I think, in the way that it's behaved, that there isn't going to be an increase in borrowing because Andy Burnham, should he become PM, will be under the influence of people that understand these market dynamics. But actually, I think that's to underestimate the risk that the fiscal rules are tweaked. And that's not necessarily a complete overhaul, but both Jim O'Neill and Andy Haldane, for example, have talked about the possibility of changing the time horizon over which the fiscal rules apply, changing the debt definition, even changing the way the OBR operates could be on the table. And so and of course, Jim O'Neill specifically has talked a lot around the, opportunity to borrow more to invest, under the investment part of the fiscal rules. This, he talked about there being lots more space to borrow more there to invest. So, whilst borrowing to invest in and of itself is not an issue, I don't know that that's necessarily the way that the market would view it. And I believe that the market is interpreting these comments around having no plans to change the fiscal rules as seeing quite a low likelihood of even minor tweaks around the edges in terms of changing the time horizon or changing the debt definition, which would allow more fiscal space to borrow more. So it feels to me quite similar to 2024. We had a very similar rhetoric from Rachel Reeves and Keir Starmer at the time around the fiscal rules being ironclad, only for them to sort of get into office and a couple of months later, change the debt definition, free up a lot more headroom to borrow more. Now, a lot of that borrowing at the time was for day-to-day spending. Only about a third of that initial increase in borrowing that was announced in that first autumn budget was sort of dedicated to investment priorities. But I don't think the market's knee-jerk reaction to any changes to the fiscal rules would really distinguish between borrowing to invest and borrowing for day-to-day spend. And of course, the reality of the UK's fiscal backdrop is that actually its net debt servicing costs are so high that it becomes very difficult to not borrow to fund day-to-day spending. They would have to make such large spending cuts in other departments just to keep servicing the debt and not be borrowing to fund that everyday spend, that it would be very politically difficult for anybody to do. If we look at most developed countries, they're, just as a proxy, if we took 5-year yields, their 5-year yields on average this year have been less than the projected 5-year ahead nominal growth rate, and that's not the case for the UK. And at the same time, if we compare that kind of projected 5-year ahead growth rate today versus where it was pre-COVID 10 years ago, the UK is one of the very few countries amongst the developed world where that nominal growth rate is actually projected to be lower over the next 5 years than it was projected to be in the 5 years ahead of 2015. So there's a lot of fiscal issues that the market, I think, is complacent about that arise regardless of who is in charge and who is chancellor. And whilst I don't think they necessarily come to the fore particularly quickly, I appreciate that we might not get much new news on this over the summer. And of course, we've talked a bit about the carry trade being, the popular way of playing rates markets over the summer. I do think that we're at a position now where we are at peak optimism. And whether that be through the way that the market is pricing fiscal risks, its perception of inflation risks through oil prices, or the way that it's pricing the BOE's reaction function, I think that there could be a moment of reckoning, once we get further into the summer. And I think that the upside pressure on yields will eventually emerge. Okay, that's probably enough from me on the UK side. Let's switch over to Europe. Oriane, it's obviously the Sintra meeting next week. Are you expecting anything out of that?
Right, so at the Sintra meeting, as always, there will be some headline risks around ECB speeches, and there will be a clear concentration of the speeches, of course. This week, we heard fairly hawkish comments from ECB Speaker Schnabel. That is not particularly surprising for her, I would say, because she's a known hawk. But she did say that from today's perspective, the ECB may still need to raise rates to bring inflation back to targets. It was interesting to see how little market reaction there was to these comments, but I think this makes sense given oil prices have been lower overall this week, and Lagarde had also struck a more dovish tone recently. And overall, it fits our views in general for the ECB. So we've been arguing that ECB speakers are likely to maintain a hawkish bias through the summer and possibly even beyond the September meeting. So we wouldn't be too surprised to see some hawkish, comments at Sintra next week in that context. I think using hawkish rhetoric to keep inflation expectation anchored is probably the main tool central banks have in the current environment. And perhaps this explains also perhaps why the market is still pricing about 18 basis points of hikes for September. On our side, we would fade that pricing. Oil is normalizing. There are still no clear second round effects. And medium-term inflation expectations remain well anchored. For instance, if you look at indicators, market indicators, such as the 5-year inflation swaps, they're now below 2.10%, which is broadly back to pre-Middle East conflict levels. We don't dismiss the risk of indirect inflation effects this year, but I think ultimately the ECB should react to medium-term inflation and inflation expectations. There is some discussions around delayed effect from oil into, for instance, food or fertilizers, but these are not true second round effect dynamics, I'd say. So if current conditions hold, in particular if oil continues to normalize or stabilizes, which is of course, a big if, I'd struggle to see the ECB hiking against this year. Next week, apart from Sintra, we'll also be watching for the euro area inflation print. The market is currently expecting around 3.1% year on year. But I'd say the recent drop in energy prices back to pre-Iran conflict levels, if it is sustained, materially changes the outlook for both inflation and growth in the euro area beyond that single print. Our economists have actually run some simple back of the envelope calculation, and if energy components gradually return to pre-war levels over the next 3 months, then inflation could be around 2.5% by September and move well below 2% in the second half of 2027 due to base effect. So that would imply average HSCP below target in 2027. Of course, these are back of the envelope calculation. There are other factors to take into account, but I found it interesting looking at this kind of energy component dynamic, and that would again point out to a reduced need for hikes this year.
Okay, so it's quite a different story potentially then from a euro area inflation perspective to the UK. Switching gears a little bit, we've obviously had quite a few funding plan updates this week for Q3 and then for the second half of the year as well. What's your updated view there, and what have we learned this week in terms of funding plans?
Right, so we were indeed expecting the German Q3 update and the EU H2 funding plan, and they both came broadly in line with expectations. So no real surprises here, which I think was likely the intention as well. And unsurprisingly, there has been very little market reaction to these. So the EU confirmed 180 billion of issuance for this year, which is unchanged. That means they have completed about 55% of their annual funding so far, which is slightly behind France, Spain, and Italy in relative terms. And that 180 billion figure is, of course, the largest annual issuance number coming from the EU so far. And even with the NGEU program coming to an end, there are still several active programs and meaningful rollover needs into 2027 for the EU. So it means issuance should remain elevated in coming years. But it's not necessarily a negative, I think, for the issuer. It really reinforces the EU position as a sovereign-like issuer and could over time support also index inclusion. This hasn't been necessarily discussed much recently, but I think it remains a relevant medium-term theme. On Germany, again, no surprise. It looks more likely we'll see a syndicated tap of the 30-year bond rather than a new line, probably after the summer. And Germany has around 45% of its issuance still to complete this year. And while there's been some delay in defense spending rollout, I'd say fiscal expansion is still coming. It is large and it is a multi-year story. And I think in the current geopolitical context, higher spending on defense as well as AI and energy really looks inevitable in Europe. And I think over time, it should point to higher bond yields as a medium-term and longer-term theme as well, and also support further spread compression across countries in Europe.
And on that note then, because I think spread compression in general, but particularly in France, has been a key theme of client conversations of late. I was in Portugal earlier this week seeing some clients, and that was something that came up in every meeting was, what's the scope for spread compression in France in particular to continue through the summer as we head into budget season and then, of course, the elections in early 2027?
Yes, I agree. We had quite a lot of discussions with clients recently on France. So clearly seeing the interest picking up again. I think partly the focus is shifting away from the Middle East. And as you said, investors are starting to position for summer carry positions. And we don't see strong catalyst for widening in the near term, at least not on domestic politics. And in France in particular, I think it's, ahead of the budget season, it's broadly understood now that there will be some form of budget in France this year, even if it's a rollover budget, even if it's not ideal. And on that note, today, the French auditor highlighted the lack of a credible medium-term plan and, discussed the state of public finances, advocating for a stronger consolidation. And I think while we agree that the fiscal numbers are not particularly strong, this is not a new theme for markets either. This is not something that, has warranted any kind of spread reaction. And I think quite importantly as well, recent widening episodes have not been driven by fiscal risks in the past couple of years, but more by political risk. And on that front, the presidential election in April is still a long way off for markets. I think positioning too early on that risk could be costly. We would expect markets to become more sensitive later in the year. I think in the near term, even if the budget process is challenging, which probably will ahead of a presidential election. And if, say the government collapses as it did in 2024 or in 2025, a caretaker government could, remain in place until the election. And I think that should limit the widening risk. That is clearly not ideal, but it's not a disaster either. And on its own, I don't think it would justify a move towards, for example, 90 basis points in 10-year OAT bond spreads. So on balance, I think we are, probably a bit more on the constructive side for the coming months. We don't downplay the risk of the budget being complicated or even a government falling. We just don't think that the sensitivity of markets is going to be that high just ahead of the presidential election, which I think is going to be the focus. But it will be a focus either later into 2026 or even in Q1 2027. So we are relatively comfortable and perhaps more comfortable than some of the clients with whom we discussed holding French risks in the summer and a little bit beyond. That said, some pressure will probably materialize as we approach the election. Headline risk will obviously increase, particularly around fiscal policies in Europe and opinion polls. But I think quite important here as well is to reiterate the fact that French risk should remain largely idiosyncratic as it's been in the past. I think for broader contagion or a more significant market reaction, you would need a tail scenario to materialize. So, for example, a populist president with a working majority or coalition, strong Eurosceptic views, and the ability to implement that agenda, a willingness to, implement it once in power. And really at this stage, I think this is still seen very much as a tail risk by clients.
I would share that assessment that you just made around our sort of more constructive view on France being a bit different to the kind of consensus view that we hear. I'm not necessarily through the summer, but I think as we emerge into September, there will be a fair bit of nervousness around the budget process. I guess that's all we have time for this week. So thank you, Oriane, for joining me. Thank you to our listeners for listening in. Just a reminder that if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other NatWest podcasts, Currency Exchange and Trade Links. Thanks. See you next week.